Hello and welcome. In this lecture video, I'll be reviewing some practice problems revolving around accounting for purchases of merchandise inventory. All right, so I want you to pause the lecture video and do number 86, 89, and 90. And with 86, it says the gross margin ratio. That's something new. We haven't talked about that, but all that is, it's your gross margin divided by your sales. So you were expressing gross margin or gross profit, gross margin, gross profit, same thing. Gross profit or gross margin divided by your sales, okay? And so it's expressed as a percentage. And so now that I've told you what that is, I want you to do number 86, 89, and 90, and then come back and we'll check it, okay? Okay, hello and welcome back. So let's see how you did. So the first one, a company's net sales are $676,600. Cost of goods sold was $236,810. So then its net income was $33,750. We don't need to worry about the net income. That's not what we're looking for. Remember, net income is equal to our gross profit minus our operating expenses and other expenses to get down to net income. So we're talking about gross profit, which is simply sales minus cost of goods sold. So this is in there because I'm evil and I'd like to confuse you. That's all that is, okay? I'm not really evil, okay? So we take our 676 minus our 236,810, gives me my 439,790, which is my cost of good, which is my gross profit or our gross margin, divided by our sales gives us 65%, which is D, the right answer. Let's look at number 89. Credit terms 210 and 30 are interpreted as a 2% cash discount if the amount is paid within 10 days or the entire amount is due within 30 days. Number 90, a trade discount is basically B, a reduction in price below the list price because of a large quantity purchased. All right. Let's look at number 92. So I want you to pause the lecture video and do number 92, and then I'm going to quickly give you some hints on number 95, and I want you to do number 95, all right? So I think you can do 92 on your own. Let's look at 95, though, just to give you some hints. So as a company purchased $4,000 worth of merchandise, transportation costs were additional $350. The company later returned $275 worth of merchandise purchased and then paid the invoice within the 2% cash discount period. The amount paid for cash on the merchandise. So when you're doing this problem, you have to take you can't take the purchase discount on the transportation costs, okay? You have to pay for those separately. So to figure out the purchase discount, you're going to take the amount that you purchased minus the purchase return, because remember, we can't take the discount. We have to take the purchase discount on the outstanding accounts payable. So that's going to be the 4,000 minus the 275. And then you can take the purchase discount on that number. And then you have to add the transportation costs separately. So transportation costs are separate. They're not included in the purchase discount. Okay? So with that, why don't you pause the lecture video and do numbers 92 and 95, then restart it and check your work. All right? All right, hello and welcome back. So let's look at number 92. The company uses a perpetual inventory system and records the following entry. Debit, accounts payable, credit, merchandise, inventory, credit, cash. What does that journal entry reflect? D is the right answer. The payment of the accounts payable, that's the debit to the accounts payable. So we're paying off the accounts payable. And then we can take our 50 divided by our 2,500, and you can recognize that's a 2% discount. That's our purchase discount. And then 98% of the 2,500, this is how much cash we pay. So D is the right answer. So let's look at number 95. The right answer is D. And so what we had to do, right, as I was saying earlier, you take the 4,000, which is what you paid for it, and then you return 275. So we did this in an earlier problem where we said we can't take the discount we can't include in the discount the amount of the inventory that you returned. You returned that. So that took off $275 from your bill. So your outstanding accounts payable that you still have to pay is 4,000 minus 275, and you can take that 2% discount, which means you pay 98% of that, 2% off, based on that. And then you add the $350, which is your transportation costs, your shipping costs. You have to add that in separately. And that's how you get to D right there. All right. So let's do number 96 together, okay? So what this is saying, this is referring to our implied annual interest formula. All right. So let me write out our implied annual interest formula. So what we do is we take 365 days, okay, divided by our credit period minus our discount period, okay, times our cash discount percentage. Okay, this is our implied annual interest. That's what that is, okay? So when we think about that and we apply that to this problem, right, we can say our 365 divided by, now we have to look at our credit period in terms of days and our discount period. Our credit period says right over here 45. So our credit period is 45 days minus our discount period in days, 15 days. That whole amount times our 2% discount right over here times 0.02. And what that gives us is D, 24.3%. So let's think about that in the context of the problem. It says right over here, by not taking advantage of the cash discount, the buyer is losing the equivalent of 24.3% annual interest. So what this is telling you is that if you buy merchandise inventory, if you are the buyer in this situation and you waited for 20 days to pay your accounts payable, you're foregoing the equivalent of 24.3% annual interest. That's a lot. That's like a credit card. So what this is telling you is that as the buyer of merchandise inventory, as much as you can, take advantage of these purchase discounts. And the way that we can figure out the opportunity cost of not taking that discount is by using this formula. 365 divided by our credit period in days minus our discount period in days times our percentage, which is our purchase discount right over there. I wrote cash discount percentage, but it's also, think of it as, it is the purchase discount, okay? 2%, 24.3. So in this case, they need to pay it within 15 days. Or look at that. That's a big opportunity cost, all right? Okay, so I'm going to end this lecture video now, and the next one we'll talk about accounting for merchandise sales. Thanks so much.